the market isn't pricing in a disaster scenario where oil flow stops. The market is, I think, looking at this and concluding that, yes, it will drag on for a while, maybe technically another $10, $15 upside to 90 WTI or so. We're going to see shale respond and other producers respond, but we're not really talking about an existential crisis in the oil market at this stage. It hasn't got carried away yet.
I'm curious, as an energy or commodities guy, are you expecting Russia and Vladimir Putin to get involved as a mediator, to literally lean on Iran and go, look, guys, negotiate a diplomatic solution, probably better than what could have happened?
Well, certainly he's been getting a lot of support for the Ukraine war from Iran, and having his Iranian ally being devastated is not in Russia's interest either. So I suspect, that's not an unreasonable hypothesis where Iran is pressured from all sides not to make this into a bigger crisis than it already is. And let's face it, vast majority, a significant amount of oil to Asia, this region, flows from the Gulf states. And it would, you wouldn't win any friends by spiking prices, and that would include China.
Yeah, probably not. Understood, right? As the biggest marginal buyer of oil in the world, right? China. So the price action in oil, interestingly, ahead of just on the back of the initial strikes, spiked up. But now, again, just a quick price check. We've got front month at 74.46, up a little bit more than 2%. Up by roughly the same quantum. The global benchmark, we're at 75.73. So, I was talking to an earlier guest, and I was saying, I'm a little bit surprised that the price moves haven't been even more aggressive or bigger. Is it a similar story when you take a look at how gold has reacted?
I think several things here. One, I think the market is not pricing in a massive disruption of global supplies. But on the other hand, demand has been quite weak, and we're still looking, if this Middle East situation didn't happen, the market was looking at significantly lower prices than we are now, because we're looking at surpluses over the next few quarters, global growth maybe of about 700,000 barrels per day in demand this year and next year. China really not growing extremely strongly. So we were talking about a surplus. Now we're still talking about a surplus, but there is a lot of geopolitical risk being priced in. But we could be significantly higher if the markets did think that this is going to get carried away. At this point, I don't think we're pricing that at all.